Good evening, and welcome to this week's special presentation entitled Valuable, Actionable Information versus Data. My name is Glenn Tompkins, Senior Instructor here at VectorVest, and it's my pleasure to bring your presentation this evening. So folks, a new year and a new host of stock data. We get inundated by emails, newsletters, analysts, and TV talking heads, social media outlets, all kinds of videos talking about the stocks that are going to go up 10, 20, 100 times in this next upcoming year. Folks, this is a lot of data that's given out, and you have to go beyond that when looking at trying to find the best stocks for the year. When you look at these outlets, they tell you why they like the stock, what news is driving the stock. And this is big right here from a prediction standpoint, how much it will increase over the year. You need to get in early. They use terms like that, and you don't want to miss this opportunity. And I say blah, blah, blah. It's a lot of hype. Folks, you don't want to always buy into the hype. All of this is just data. Now, when you look at just buying into the hype, you have to take the other side of the equation, which is to do your homework before you just blindly buy into what someone tells you to do. You can buy off of an email or off of a periodical or off of an influencer that you feel you really, really like and they've done well for you in the past. But you've got to go beyond that and do your own homework. Now, in doing your homework, you need to know a few things. What a stock is worth. Why? Because we want you to buy into undervalued stocks. Now, not every stock out there is undervalued. That doesn't make it a bad stock. It just means that people are willing to pay a premium to own that stock. You need to know if the stock is safe. Why? Because unsafe stocks tend to be riskier stocks. If you're not in the space of wanting to take on a lot of risk, then utilizing an indicator to tell you if the stock is safe or not is very important to you. This is key. You got to know when to buy, when to sell, or when to hold. Just because a stock looks good and just because it's fundamentally sound doesn't always mean it's the right time to buy. In regards to selling, you don't want to sell too early. You don't want to sell too late. You've got to have some kind of stop criteria in place to let you know when it's the right time for you to sell. And sometimes holding is not so bad either, especially if a stock is going through some semblance of consolidation. Wait and see if the stock hits your sell criteria, then get out. But a lot of times we get out way too early because we try to outguess what the market's going to do. This is also key. Make sure that the stock is right for you. Everyone in here invests differently. So I may want to take on the risk of having a riskier stock where many of you may not. I may want to take on the risk of, well, maybe the stock doesn't have great upside, but it's moving up right now and I want to take the short-term trade. That's okay. As long as you know where you stand in the opportunity to buy stocks or where you stand as far as how you invest in the market, make sure that you invest in the right stocks that are for you. And folks, putting all of this together is the valuable, actionable information. Actionable because I can take action. I can know when it's time to sell that stock or when I want to actually jump into that stock. And the information separates from the data. The data is just data points. The information helps you to make better decisions. Now, with all of that, we have the tools that no one else has. I'll say that again. At VectorVest, we have the tools that no one else has. People have asked me on more than one occasion, well, who's your competition? Well, nobody does exactly what we do. So in essence, we don't have competition, but we have the tools to help you to make better decisions. We dissect the data into useful information, and this information builds a solid foundation. For anything to be strong, it needs a foundation. And the information in our indicators give you a solid foundation to build upon. This information sets us apart from everyone else. And you know something, with all of this great information, I always like to say we do the work and you reap the rewards. So let us help you start off the year right. Let's get started. All right, so I've created a watch list of stocks. Now, before anybody jumps out there and says, is this what VectorVest is telling us to buy for the year? That is not the case. So I went out to Google and I went out and said, to see what everybody was out there talking about, what are the best stocks to invest in for 2022. These stocks are going to explode. They're going to do great. These are dividend, all of that. So I looked at and I found some stocks that a lot of you know about. I didn't want to come with stocks that you guys didn't know about and be like, what the heck is that? So these are stocks that you know about, and a lot of different websites, a lot of different talking heads, a lot of different people on YouTube are talking about these stocks. So I comprised a list of 10 stocks that are out there being talked about in the world as far as stocks to invest in for the year. All right. And I'm going to talk a lot about the indicators, which are 1, tools, and 2, information, not just data, to help you to make better decisions on these stocks that people are talking about. So 10 stocks. The first indicator I want to look at is value. Remember, I told you that we have tools that nobody else has, and I'm going to expound upon that right now. Value is what we feel the stock is currently worth. Value looks at things like earnings and earnings growth, amongst other things, to give an intrinsic value on every stock in our database. Now, a lot of people will say, well, I want to look at the PE ratio. If the PE ratio is low, then I'm going to think that that stock is undervalued. The thing about the PE ratio is that it's subjective, because I can ask somebody, hey, what do you think about this PE? Well, I think the stock's undervalued. I can ask somebody else, what do you think about this PE? Well, I don't like that PE so much. It's a subjective indicator where when we give an intrinsic value on a stock, it's very objective. This is what we feel the stock is worth, and this is where the stock is trading. So I look at CVE, currently trading at 1440 with a value of 1960. It meets the criteria of being an undervalued stock. Why do we like undervalued stocks? Because price and value tend to meet or come together at some point within 3 years. And if that's the case, we look at undervalued stock because most likely price is going to rise up to meet value. That's why we like to be in undervalued stocks. So let's go to the next indicator. Relative value. Relative value looks at a stock's upside potential. Notice that I didn't say that where it's going to be at any point in time throughout the year. It's got upside potential. Cast on a scale between 0 and 2, where above 1 is favorable. When I look at a relative value on CVE at 1.74, on that scaling between 0 and 2, it tells me that CVE should, key word there, should outperform a AAA corporate bond by 74% over the next 1 to 3 years. This stock has great potential to the upside, but I'm not assigning a certain percentage that it's going to go over the year. I'm not predicting, but I'm giving information that should tell you as a long-term investor, I shouldn't be afraid of owning this or holding this long-term. The next indicator, relative safety, RS. Still on that scale between 0 and 2. It's an indicator of risk. Remember, that's important. So someone can tell you to go buy a stock, but how risky is it? Relative safety is that information that can give you that kind of helpful insight. Relative safety above 1. Relative safety looks at a stock's ability to meet or exceed its earnings expectations quarter over quarter, year over year. Consistency and predictability of financial performance. Remember, earnings is the engine that drives a stock's price higher. If a company continues to meet or exceed its earnings expectations, it makes it very attractive for people to buy into it. Relative safety above 1 tells me that the stock has a high probability of meeting or exceeding its earnings expectations, and above 1 tells me it's a less riskier stock. Now, these two are our fundamental indicators. RT is our technical indicator. When we analyze stocks, we use fundamental analysis with the insight of technical analysis to give a well-rounded view of analyzing the stock. So relative timing above 1 is favorable to stocks in an uptrend. The higher above 1 it is, the faster in an uptrend it is. RT at 1.56 tells me that this stock is going up nicely. Now, we take all three indicators, wrap it up into one indicator called VST, value, safety, and timing, and it's our master indicator for ranking stocks. As I put these 10 stocks into this watch list of stocks that are being talked about out there, the stock that had the best combination of value, safety, and timing automatically migrated to the top of the list, and the ones that had the lowest VST migrated to the bottom of the list. This list, looking at what you see here automatically starts to do work for you. If this is your list of stocks that you've gotten from your emails, from your YouTube, from everything else, VectorVest already went to work for you and put them into the best combination of value, safety, and timing. Now, next indicator, another technical indicator, CI, tells me if the stock shows me the stock's ability to withstand long or lengthy price declines. These are high CI stocks are very resilient. We call them price growth persistence. These are stocks that consistently go up more than go down. We give a buy, hold, sell recommendation on every stock. Folks, we're still doing the work for you just by building a watch list. We look at earnings. We look at how much they grow their earnings growth rate. They're growing their earnings at 45% a year. Good googly muggly. You got to love that. If a stock pays a dividend, another tool that you have in your VectorVest tool belt is dividend safety. No one gives you dividend safety. Above 50 tells you that this stock should be able to maintain or grow their dividend. Wow. Again, folks, when you look at what we offer to you as far as your tools, the tools will give you that actionable information. Now, as I just went through all of these, for those of you who are brand new to the VectorVest software, if you right-click on any one of these indicators and go down to View Full Stock Analysis Report, you want more information on each one of these indicators that I just gave you, here it is. All right, for those who are brand new, I suggest you open up one of these, print it, and you always keep it by your computer so that you always know what these indicators mean and how we get to them with as much information we're going to give you. All right, so let's go look at DVN 50, value 68, undervalued, good upside potential, giving up a little bit of safety, a little bit more volatile than CVE, but not greatly off of the value of 1, going up, good VST, high CI, buy recommendation, good earnings growth rate. It does pay a dividend, and the dividend safety is at 70. Ford, everybody knows about Ford. Now, trading at 24 with a value of 26, good upside potential, giving up a little bit of safety on that. In an uptrend right now, buy recommendation, good earnings, growing their earnings at a clip of 21%. Home Depot, everybody knows about Home Depot, but look at this. Trading at 374 with a value of 352. This is one of those opportunities where the stock is trading over its value. That means people are willing to pay a premium to hold or buy Home Depot. But look at the upside. The upside is there. The stocks should outperform that AAA corporate bond by 39% over the next 1 to 3 years. It is a safe stock, and actually out of the top 4 that we're looking at, it is the safest stock so far. What's hurting it? RT is below 1. So remember, fundamentally sound just may not be the right time to buy it. This is information. You're not just blindly buying because some periodical said, hey, Home Depot is going to go up 1 trillion billion % this year. You got to go buy it. You don't want to miss out. You got to get in early. May not be the right time to get into it. That's where the information comes in. It's a hold recommendation. Good earnings, grows their earnings at a clip of 18%. Notice, even though it's the safest stock, it's not growing its earnings nearly as much. Again, this is where the information comes in. Pays a dividend safety of 90. That's a great dividend. mRNA, well, we know what's going on with the coronavirus. mRNA is out there, 204 with a value of 478. Nicely undervalued. Look at that upside potential. Wow, way up there. Safety above 1. What's hurting it? Aha! It's in a downtrend, in a big downtrend. Fundamentally sound, undervalued. It's not the right time to buy. It's a sell recommendation. Again, I can go over and over and tell you this is actionable, useful information. Cognizant, 86, value 90, slightly undervalued. I'm going to call that fairly valued. Good upside potential, good safety, in an uptrend, everything good about it. 450 earnings per share, growing it at 15% a year. It does pay a dividend, 81%. 81 dividend safety. That's great. Amazon. Everybody knows about Amazon. Trading at $31.97, value of $13.69. Grossly overvalued. Well, that's because it's so talked about and it makes money. People are willing to pay a premium to own the stock. good upside potential, not as good as some of the other stocks, but nonetheless good, fundamentally sound. What's hurting it? Aha, RT is below 1. It's a hold recommendation. Earnings per share, $52, grows it at a clip of 24%, does not pay a dividend. iRobot, 66, value 59, slightly overvalued, good upside potential, good safety. What's hurting it? It's going down in price. Sell recommendation, positive earnings, grows it at double-digit clip, no dividend. Zillow, well, we know what happened. They got out of the business of buying a home online, right? Got Open Door and other things like that. But Zillow took a hit because of that, didn't it? Price at 53, value. The value fell on that stock. So even though somebody's talking about, hey, it's going to have a comeback, blah, 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 well, it's overvalued. It's got good upside potential. It does have some risk associated with it. It's going down in price. So no matter what somebody's telling you about it, may not be the right time to buy. Does have positive earnings, grows at a clip of 41%. So even though they're not selling houses online, the company still makes money. Just may not be the right time to buy. Last but not least, Etsy. Everybody knows about Etsy. Trading at 161, value of 98. Overvalued, good upside potential, safety is there, but actionable information. RT tells me it's below 1, so it's not the right time to get into it. Data is saying buy these stocks. Information is doing the analysis of the stocks. The actionable part of it tells you, is it the right time to be in it? Now, you know what I also like about this? From an informational standpoint, in a tool that we have, here's all 10 stocks. Look at the watch list average down below. I can tell you, based on the fundamentals, this is more of a prudent group of stocks because relative value and relative safety are both above 1. The portfolio or the group of stocks as a whole may be going down in value or going down in price right now. But so how do I know about the type of investor I am or that this is a prudent portfolio? Let's go on to my next slide here. We have the investment matrix, another tool to give you helpful information. Notice, we're going to say that there's 4 different types of investors: prudent, aggressive, speculative, conservative. Based on that, we look at these indicators, relative safety and relative values, and where they are in the spectrum between 0 and 2. Based on where they are, we can see where the risk and the reward are. Reward high, risk high. Let's go start from the prudent. Relative safety above 1 and relative value above 1 puts us in the square of prudent. That's where a majority of the people are. And when I have relative value and relative safety on that portfolio, both above 1, that's a prudent portfolio. Well, how about aggressive? Well, then relative safety is going to be below 1. Relative value will be above 1. The upside potential will be there, but I'm willing to give up a little bit more risk to get the big pops. That makes it more of an aggressive portfolio. Speculative, relative safety below 1, on relative value below 1, relative safety below 1. That's when they throw caution to the wind. And this is where a lot of stocks that are out there, people are talking about, hey, this biomedical company is going to go gangbusters. You need to go buy it. When you go look at the relative value and relative safeties on those stocks, you'll see that they're more of a speculative play. Now, is there a space in your portfolios for speculative plays? Absolutely. But not everybody wants to be in that space. But if I can look at the analysis on the VectorVest system and see that the relative safety is below 1, relative value is below 1, it's a speculative play, I now have the actionable information to make a better decision. And for those people who are more conservative, risk low, reward low, you know something? People say, well, I don't want low reward. Well, you want conservative stocks that or portfolio that goes up slow. Prudent, you're going to get big pop. Aggressive, you're going to get super big pop. Speculative, you're going to either get a big pop here or a big pop down. Conservative is slow, steady, lethargic move. Boring. But a lot of people want to be in that. So that's where the low reward comes from, but low risk. People want low risk, don't they? They do. So the conservative, relative safety above 1, but relative value below 1. I don't care about the upside, big upside pop. I care about less risk. So looking at the investment matrix is another tool. How do I get to the investment matrix? If you want to get there, go to the Views tab. Go to the Strategic Investment Matrix, and you will be able to see what I just showed you. Now, Before we end, I want to tell you that the green book, Stock Strategies and Common Sense, the little green book that Dr. DeLito wrote, has got an update to it. Click here on Stock Strategies and Common Sense in the Views tab. Click right here where it says click to download. This will come up for you. This is the newest version, copyright 2022 by Dr. Bart DeLito, 3rd edition, January 2022. We've got some updated information in the little green book that is available for you right here, right now. All right, folks, I want to say thank you very much for joining me for this evening's presentation. Let us get you started on the right foot going into the year without predicting anything. We are going to help you do your homework and build your portfolio and transform from where it is now to where you want it to be over the next year. And until the next time, folks, if you have any questions, give our product support staff a call. On Monday, I will be doing a Q&A session. If you have any questions, make sure you bring them to me. I will be more than happy to answer your questions. That will be, I believe, at 2 p.m. No, check with product support. I believe it's 2 p.m. On Monday. We'll go through and answer your questions. Until the next time I see you, folks. See ya.